Happy Thursday, Mr. Bouchey.
Happy
How are you?
Thursday indeed.
How are you, sir?
Feels like summer over here. It's we're finally getting some warm weather and sun is shining. Looking outside, and I think for the rest of the weekend's actually supposed to be like the 80s. So we're spring right into summer. It feels like so all good here. If we could just get for at least the next 15 minutes heading into tomorrow, if we get the markets to kind of hold a little bit, would be a good way to at least end today. But yeah, it's just, oh my God, this volatility this week, it's something else.
It's been this way all year, brother. Not as bad as the last week, but yeah. So yeah, I thought I'd bring out the palm tree shirt. Get a little cheer. I think it's 85 out there. Good weather here in the East Coast. I threw some chemicals in the pool, so you got to throw salt and all that stuff in there. Long story. I have a well point, so I lost all the water in my pool. All the water drained out this winter, so I was constantly filling up the pool. But I have a well point, which like you drill down about 20 feet to get groundwater up. Well, it's hard water here in Saratoga. I think you know that. So when we put all the chemicals that the pool store told me to put in, it turned the water brown today. So the kids are all excited to swim this weekend. So I just ran back, and they gave me something that's supposed to counteract the copper and the iron and in the pool. So that's I don't know.
Can't swim in brown water, so good luck there.
Yeah,
Good
right,
luck there.
right. With the way inflation and commodities are going, maybe we can like sort of harvest some of that out there and sell it.
Yeah, mind that.
All right, so guys, welcome Thursday live stream. We are New Age Wealth Advisors. We are financial advisors. We focus one-on-one on retail clients, formulating portfolios that suit and tailor your individual circumstances. I generally hang on the portfolio management side. Ryan, with his impressive credentials, does tax planning, strategy, organization, and he certainly helps me on this end as well. So that's us. This is our take on the market. It's been obviously busy, so much to talk about. We just wrote a 3-4 page update to our current investors, just talking about how we see the market, different things that we're going to pull out some of those points here today. And Ryan's got a lot going on his end. He's currently, and I asked him ahead of time if he wanted to talk about this. The answer was yes, but he. As we started this business, he wanted to move closer to his wife's parents in Boston, and he entered the grueling and nasty Boston real estate market. But we have some positive news, RB. Would you care to share?
We're under contract, so
Yeah,
we're getting
baby.
closer. We're getting closer. It's been a wild ride. I mean, I know there's other markets that are hotter than Boston, but Boston's been pretty hot, and so so a couple negatives, right? Markets have gone up probably 20+% year over year. That's not ideal. I had an interest rate in the mid 2.55 back in February. If I could have found a house, could not.
I still don't believe you. Are you sure this wasn't like a cash in the bag and it dropped off in the backyard kind of deal? Like, I don't know how you got those rates.
Yeah, I'm locked in right now for 4.1, which hurts versus 2.5, better than the national average, which is almost up to 5.5 now. So feeling good there. But I think one of the positives, and I'm looking at the Wall Street Journal has an article. I'm guessing it's coming out in their housing section for Fridays. They have a housing section on Fridays, and they're talking about the break-even point, right, for home ownership, and how it's been extended now because of pricing and everything else. And when you buy, and I've written about this because of just my personal struggles of finding a home, but just relating it to what I'm going through. The calculations of what's right and what's best for your own situation, you have to factor in so much more because again we're buying at these inflated prices. I don't foresee a drop in the market anytime soon, but I do think we'll have a slowdown. But you have to be aware that maybe there is going to be a pullback, and if you're only going to plan to be there 3, 4, 5 years, that may not be ideal for you. But the one big thing that we came away with, and we've been here for almost we're here now like 9 months or so. We did realize we took our time, and we know really where we want to be. And I think that's one of the biggest takeaways. And I was actually speaking to somebody yesterday, younger individual, looking for his first home purchase. And I think there's always been this kind of misconception or conversation of, is it better to rent or buy? And in this market environment, I do think like you really need to be sure of what you're buying. And the thought that you're throwing money away on rent just isn't always the case. And we've been renting for the last 9 months. We were able to really understand where we wanted to be, kind of the lifestyle that made sense for my wife Nikki and I and our kids. So I think we're moving somewhere different than we would have moved 9 months ago. And I think now in hindsight it's a really good thing, because if we had moved in or bought that house at lower prices or better rates some time ago, we in a couple of years we may not
it still
be
would
as
have
happy
cost
as I think
you.
we would be.
It still would have cost you if you want to move.
Yeah, and
Right,
it's
right.
expensive. So take your time, be sure of it. I know it's a tough environment for that. Anyone who's in the same boat, and like I said, whether talking to clients, friends, who you name it, I always say renting. I mean, you're a homeowner. There's a lot of cost with home ownership. There's nothing wrong with renting. It's not totally throwing money away.
No, I mean, and what are you going to do with it? Like, we got to get into the market, and in the time we've been talking, we should just keep yapping. The Nasdaq was down 1.1%. Now we're only down 0.67% against the support level that we're going to talk about. But and if you can get access to it and you can comfortably do it, don't forget you are in a position if you're borrowing money at 3.5 or however Ryan did it at 4. I don't know how he did that. He's got some deal going, but the rest of the Americans are paying 5+% on a 30-year, but keep in mind the money is being inflated or eroded by 7 to 8% right now. So you're still, your net borrowing is still plus 3%, right? Your payment is going to stay the same as the value of $1,000 or $2,000 or $3,000 mortgage payment is worth less and less as the years go on. If we have inflation that is no longer bordering on deflation. We couldn't get 2%. It was everything the Fed wanted to do to get some kind of sustained inflation above 2%. Be careful what you wish for, because boy, I have it now. They don't know what to do with it. So now we wonder what the new norm is going to be for inflation, and that's going to correlate, obviously to higher borrowing costs. But if our new floor is, let's say, 2.5–3% inflation. If you have a 4% loan, that's still you're in pretty good shape. Kind of related to that in volatility, we can talk about that. There was a long time in 2016, 17, 18, 15 through 18, I would say, when volatility, the VIX, was kind of fixed at like 10, 11, 12. That was the floor, and that was a market just going straight up. Now all of a sudden we've had a mean reversion. So we were actually in 2016 and 17 a realized volatility in the market. The lower the volatility is, and vol is nothing more than up and down in the market, which equates to fear, it was the lowest in 100 years. We're getting mean reversion in terms of higher realized volatility, which I think it all correlates together. So this up and down kind of stuff that we're seeing is here with us to stay, like I think inflation is here with us to stay. Maybe not at 7 or 8% a year, but that's why we really believe when the whole industry went, passive indexing is it, active management is dead. Dude, you are at 100+ year lows in realized volatility in the Dow. I have the charts to back it up. We're mean reverting in terms of realized range of volatility. We're not even in the middle of the range of the last century, high to low on a quarterly basis for the Dow Jones. We can go more into that, but the world is changing. And I think what you're saying is we're all discovering things, and the norms that have been the way for a long time, low inflation, low interest rates, low volatility, it's changing, baby, and that's why we're active. What say you, sir?
Let's lead in. I know you wanted to lead into some technicals of you know, the major indices, why don't we just jump into kind of what the markets are doing and
Love it.
take a
You know,
look.
by the time I'm done, anybody want to make a bet in the next 4 minutes that the Nasdaq finished positive? Anybody want to
gonna
take
be
that bet?
close.
It's gonna happen. Watch this. Let's get the YouTube window up. I know we're trying to get this YouTube channel back in vogue. A few people here. Tell your friends, your family, come on in. Hit the little thumbs up button if you're watching now or after the fact. Let's do some technicals real quick. Let me show you what's going on. When volatility, when vol picks up, as we were just talking about, the ranges go up, the emotions go up, the news gets crazy, and basically what happens is the technicals or just the studying or viewing of the market through charts becomes more important. Okay, it's when the markets are quiet and boring and dull and just go straight up a little bit every day. Technicals don't really matter at that point. But when things get hairy is when they really matter. So let me just give you a quick, simple rundown of the way we see things now. I'm relying big time on my own life as a hedge fund trader, trading for my own account, very technically driven intermarket analysis, macro, and fundamental trader, but I really relied on technicals for a long period of time. And it's still really at the heart of the way I approach the markets. So let me just pull this up here quickly, share the screen, and just give you an overview of what we're going to talk about here. So, guys, real simply, the way the market behaves, let me just see if I can just get a little blank screen here so I can just draw something for you. Okay, so traditionally the market, the stock market, goes from the bottom left-hand corner to the top right. So the trends here, here, and here, they generally make higher highs, where the lows also generally make higher lows, okay? And it's these corrections that create a lot of havoc and chaos in the market and calls for that this time's different, and the market that's been going up since the United States was basically founded, that trend is going to end and we're going to go back to new lows. Well, every time that we've seen a correction, it takes some shape of this sort of pattern, which is down, back up. Everyone says, oh, okay, just a short-term correction. We're going to go to new highs. It either comes just short of the old high, goes up to the old high, or maybe just through, but then it catches everyone off guard, and then we go down in a soul-crushing, devastating break below the original lows. Let me just throw a little line in here, okay? And pretty much when you get this sort of thing and you break these lows, everyone says, oh, that's it. It's over. Sell your stocks. Go to cash. Go to gold. Go to Bitcoin. And that's when you get real capitulation. You get real negative sentiment readings. But what you don't notice is you see a couple things that diverge. You see fundamentals start to improve. And you actually start to see technical momentum, downside momentum starting to wane. You can go to new lower prices, but you can do so at a slower rate of change. Okay, did I win the bet? Oh, I missed it. Down 0.15%. So basically the shape that we're looking at here at the heart of a lot of corrections is this: down, up, down. And you'd be surprised, more times than not, the distance traveled, the percent decline in the initial, let's call it A wave, is a lot of times around equal to the percent distance traveled in the second part here. So the second down phase, down, up, down. Okay, that's a simplistic view. And I'm borrowing from a methodology called Elliott wave analysis. But kind of fast forwarding to where we are now in this market in the Nasdaq, let me get rid of all the gory labels here. You can, I think, pretty quickly see that that pattern that I was just describing to you. All right, so this is the Nasdaq 100. Okay, this is from the COVID lows, March 2020 lows. Market has generally been going straight up since then, and this has been the first significant correction that we've seen. Okay, so just like I mentioned, I'm just going to pull out some of the details here. You can see that down, up, down pattern, A, B, C. And you know right now, as we break below the March 2022 lows, we had an attempted little bounce here. Just recently, Matt, is when I'm hearing a lot more people talk about it, a lot more people throwing their hands in the air, and sentiment is getting very, very bearish, okay? This is where you can throw a momentum indicator on there. So a very common one that you've heard about on CNBC and elsewhere is something called relative strength index. It doesn't measure the direction of the trend, but it just measures its strength, its rate of change. Like the example I give is you throw a baseball in the air. It'll go and accelerate at some point, but then at some point the rate of change starts to slow. It'll keep going higher, but at some point the rate of change will get to zero, and at that point gravity takes over. It moves higher at a decreasing rate of change. Same thing with this indicator right here. And basically what it's showing you is the RSI reading is about 34 compared to the strongest, most negative rate of change, which was way up here in January of this year. So we have slowing rate of change combined with significant, I think, bearish sentiment. And then what I think is really cool, and this is a deciding point, the percent change distance in the first wave down, okay? So the initial decline was 22%, 22.3%. So far, right now, we are at today's close. Let's just go to the lows. So far, this is a 22.8% decline. So, this isn't voodoo magic. This is just a basic guideline. It'll say a lot of corrections do unfold in this shape. They're exactly equal so far in percent distance change. And that actual low is 11,855 in the Nasdaq. Okay, we're right there. I'm telling you right now, there's no coincidence at all. This is the 15-minute chart that we're doing this kind of price action at 1180, which is right about here. That's that 100% decline. Isn't that crazy, right? I mean, look, I'm not telling you this is the lows, but it might be. If not, and here's the next part, this is sort of the corollary to this methodology. If it's not the lows, we have an idea of where, according to this methodology, the next downside target is. You don't need to know this. If investors are here and you haven't heard me dive into this, please don't think I'm cracked out of my mind and going crazy. This is a very accepted school of analysis used by institutional traders. It's a very high-end hedge fund guys that I know. It's there. It's just not mainstream media kind of stuff. I do it in the closet. I really don't like to come out and talk about it that much. But times like now is important. And I'll just go ahead.
Well,
yeah.
I think when you're, we've talked how my background's more in, again, not so much the hands-on active approach. It's definitely been more of, longer term money, probably a little bit more passive. But I think, when I kind of think about the markets and what's happening, thinking about it maybe more from a fundamental standpoint, right? And we've talked about how, sometimes the market makes sense from a fundamental standpoint, but a lot of times it doesn't. It can be irrational or it can behave differently.
There's nothing fundamental about this right now. This is pure raw emotion.
Right.
They're throwing the baby out with the bathwater right now.
Right. And so I think it's, and the point being is, looking at some of the technical analysis, right? Some of the charts, some of the patterns within, institutional trading and kind of seeing what, again, following a pattern or understanding kind of where there's some break points to understand maybe what the next move will be, taking into account fundamentals. Because, I mean, I do think at the end of the day, you take it into account, and then taking into account investor sentiment, right? Because that's been a huge driver as well lately, is that, at some point, the emotions kick in and there can be some, just straight selling or buying, it can go both ways, let's say. I think last year being an example of the emotional buying and just, either someone not wanting to miss out on the party, being late to it, getting greedy. I mean, there's so many different factors, and I think those three elements sort of have to play into your conversation of the markets, how you're viewing them, and kind of just putting thoughts together of what's the next move and what are you doing. So when you look at that chart, because again, my background certainly not from kind of that technical analysis, what are you looking at next? What's kind of that, hey, do we see some positive movement here? Do we see some kind of negative? What are you looking for when you kind of put on your old trading hat? And I know this isn't what we're doing for clients in terms of day-to-day trading, but certainly as we're kind of making moves, and I'm sure you'll talk about it a little bit today, as we're looking to make moves within the portfolios, what are some of the indicators here that would be again, either sort of show negative sentiment or maybe some bottoming out in some positive trades?
Yeah, no, good question. I think what we've done is I and we have adapted, what I've done for the last 20 years into long-term portfolio management. We're not short-term trading. We're not getting in and out with our clients, but we're being very proactive with their long-term money. Basically, we're fighting for every 100 basis points that we can get for our clients. That's a fair statement. And I think if you can fight for every 1, 2, 3% return that you otherwise wouldn't have had compounded over a 20 or 30 year relationship, that's significant. And there's no guarantee that we're going to be able to do it. But the way we're looking at it is I've spent, Ryan is, I've been in a cave for the last 4 days. I'm looking at myself. I look like I was in the Caribbean a week and a half ago or whatever, 2 weeks, and my tan is gone. I've gone through every stock in our growth and value portfolio, and what we've done basically is in the growth portfolio, we've raised some cash. Okay, we've raised cash in the growth portfolio, and also sort of stabilized the value portfolio, dropped the portfolio beta. So what that does is it gives us two options. If we hold this support level, and I was going to show you the top 5 stocks in XLK, the technology ETF, and show you where we are in this relationship to this down, up, down move. But it gives us the ability, we went to we raised about 14% cash in the growth portfolio to give us optionality. If we start to hold, okay, we can increase the tech exposure in our growth portfolio fairly quickly and allow our investors to participate on the upside. If, on the other hand, we don't hold, okay, our next stopping point, our next decision point based on this particular methodology, which this is not a crystal ball. It's just a framework. It's a guideline. It's a set of rules and guidelines that the market tends to follow. There's no certainty. But the next stopping point is 14% lower in the Nasdaq, down around 10,100 here in the Nasdaq. So the other thing we did is we raised, we reduced the beta or the volatility, the sensitivity of the dividend portfolio to the S&P. In the event that we do head lower, hopefully the value portfolio continues to outperform the S&P. We have, knock on wood, right now some pretty good outperformance since inception and year to date in that dividend value portfolio compared to the S&P, and we'll have the same discussion if we get down another 10-14% here in the Nasdaq. We'll have the same discussion. So it's when to deploy. I do think growth stocks will come back. I think high growth, high margin tech companies making money will have a rally back. But when do we move into that, I think, is key. When do we start to move out of value into growth, into stocks that we're ready to move into? The portfolio is already selected, and I think it matters. This is long-term money, but where you allocate the portfolio can result in a difference at the end of the year that I think is better than our peers. So I mean, tell me I'm wrong, but I think we're taking a short-term approach to managing long-term money to extract as much value as we possibly can.
But it helps to be, the ability to be tactical, especially on the edges, and that's where certainly, taking this into account, looking at some of the short-term trends and being able to make quick move, it goes to our technology, being able to kind of do that for clients as a whole, all at once, being consistent with those types of moves. It does help that clients know that, hey, we're watching it, and if we find a good entry point, and it could be multiple entry points because these things are hard to predict. And I think there's all three of these, right? You're looking at sort of the technical analysis.
Yep.
I think right now with even the sell-off, yes, it's definitely been an emotional sell-off, and especially over the last couple of days, I think you're seeing kind of a more of a broad range sell-off in many ways. But it's also, somewhat you're kind of seeing those companies that are better companies, cash flow positive, not purely kind of speculative or purely sort of growth unprofitable companies. You're seeing kind of them get back to where their mark should be, and I think overall the market's a lot more fairly valued now than it was 4 or 5 months ago, and that's a positive from that fundamental perspective, right? And we're looking at the technical perspectives, and then taking into account investor sentiment, which has been extremely bearish, reflective within the stock market. And again, at a certain point, as we always say, the market's going to be forward leading, right? We're going to get some, you're going to see some positive movements in the markets before you probably get some good news. And at a certain point too, I think, we had the inflation numbers come out this week, not taken really well by the market. But it's going to take some, some positivity, not maybe on the full market, but here or there, a better reading next month, or, some consumer data that comes out, or sentiment data that, hopefully gives a little bit trigger to this market. Because again, overall, economy's we're not seeing tremendous slowdown in the overall economy, but certainly the market's reflecting a kind of a shift from some of that high growth stocks to more of those again cash flow positive.
I mean, there's been a crash. I mean, we can go through, and it's ironic today that the stocks that, if you see this leaderboard, I was just going to go through those top 5 XLK technology stocks that we want to own, but I just thought it was so funny today. This is sort of my stock watch list. These are the stocks I watch. You can sort them by percent change or whatever. Like, let's see, Roblox 20%, Rivian 18%, Unity, Sonos, Lucid, Etsy, Roku, Shopify, DraftKings, Peloton, DoorDash, GameStop, Palantir, Tilray. Talk about, all of those were up 9.5% or better. Talk about the dog poop list of stocks. I mean, there's a lot of short covering in these names that have been massacred. There has been a tech crash. There's been a crash in the high valuation, stay-at-home pandemic, liquidity-fueled, post-pandemic, people staying at home, getting stimmy checks. Either you're trading crypto or you're trading Rivian and Roblox and flaming people on Reddit. Well, that crash has happened. That's come and gone. I mean, anything more, these companies are going out of business. I think Sonos is the only one that I would actually consider owning in this group. But anyways, so let's just round this out, and we'll get. I just want to do that. Show you the top 5 XLK. So these are the top 5 stocks in the technology ETF. I just wanted to do that comparison, just sort of give you an idea of Apple is important. So that same idea of down, up, down, equality there in Apple was 147. They really took the sledgehammer to Apple. We got down around 139 today, closed about 142, so about $5 below that support level. Microsoft, we're showing good support. That equality is 243 in Microsoft. So we closed at 254. Still room to go in Microsoft. We upped our exposure and our growth in both Apple and Microsoft because we are starting to see evidence over the last week. Even in this sell-off, large cap tech is showing better resilience. Right, look at this. Visa and MasterCard are number 3 and 4 for largest holdings in the XLK. Visa didn't even break down. I think that is so interesting. We didn't even get to the equality, 177. We didn't even break lows from last year. Look at that relative strength in Visa, and you combine that with the credit card data that we saw. Americans, I think we have a graph ready for that one, and look at this. MasterCard is actually even stronger. MasterCard hasn't gone anywhere in 2 years. It hasn't gone up or down. I think Visa is going to be a little bit better play. But credit cards have been solid, but they're not moving anywhere. NVIDIA just kind of got chopped up. I think the semis were pretty overvalued. That equivalent level that I'm talking about is 172 in NVIDIA, closed at 161. So we're getting a little sell in there in NVIDIA. Google comes in. Google's below. Google's been weak. So that was the support level here. We closed significantly lower. And then one that's been very beaten up lately is Amazon, and it's not even worth doing that kind of comparison because Amazon, sort of like Visa and MasterCard, have been sideways for the last year and a half and just gotten hammered. Their last earnings report was terrible. No surprise there. So, I think there's tech that is solid and there's tech that is not. You look at Tesla. Look at the relative strength that you've seen in Tesla. Not below the February lows. holding in extremely well, even with all the stock that Elon has pledged against his Twitter purchase. I think Twitter, as much as, or Tesla's, as much as you don't, maybe you don't like Elon or like the stock, whatever, the relative strength here is just undeniable in Tesla. So there's good names that we will be owning. It's whether it's here or another 10 to 14% lower in the market. You got to have your shopping list ready now. Do you want to go? Want to do economy? Want to do some inflation, or where do you want to go next, Ray?
Yeah, I mean, I think inflation. Obviously, the numbers came back. Was that yesterday? It was yesterday.
Yep.
Tuesday. My days are getting all mixed up.
That's all right.
This week. But yeah, I mean, the inflation number didn't drop. You know, maybe some good news. Maybe we've hit peak inflation. I think the market was hoping inflation pulled back a little bit more than it did. It only pulled back 0.2% from last month's reading, and you know, still being over 8, a little concerning. We see the effects both on what the Fed's going to do. Again, you're seeing growth take the brunt of it, although have a little bit recovery today versus the rest of the market. But that was one of the pieces of data. Like I said, just the market's looking for one positive sign that either higher rates or inflation slowing down, and we did not get it there. And again, I continue. It doesn't make it any easier. We're dealing with the geopolitical issues, right? So that's hit inflation overseas in some supply chains. We're dealing with China and their supply chain. That's going to hurt inflation and kick prices up. I mean, we have all these different scenarios that are happening that it's going to, I think, be longer lasting than the Fed or most people expected, but there's still issues that I think once worked out, and whether that's in a week, a month, a little bit longer, we're gonna get some stability there, and I think it's hard to kind of see that in the immediate future, but at some point we have to see it. So it's discouraging the number was as high as it is. I'm still kind of feeling encouraged that I think we'll get some stability as the year goes on. But certainly that was the biggest news of the week, I think, from an economic standpoint.
Yeah, and I have evidence for you that through two charts I'm going to bring up next, that forward-looking markets are starting to discount lower inflation readings. So Tuesday we had CPI. Both headline and core were higher than expected. They were expecting core to be up. I think they were looking at housing prices. They were looking at airfare was expected to be high. Food was expected to be high. So it was pretty significant. And then today's PPI at the purchasing or the producer price index didn't help. Came at 11% versus 10.7 expectations, and there was a pretty big revision higher to last month's reading as well. The core was above as well, so we had wholesale price levels up. The inflation continues to be elevated, and everyone was kind of looking for that reprieve in the inflation reading, and just didn't get it. So that was a little concerning. But then I would submit to you, sir, let's look at the tips. Let's look at 5 and 10-year tips. And I say, actually, I prepared 2 charts for you. I came prepared to this show, baby. Look at this. But this is like Technical Thursday, okay, man? Did you know you could do technicals?
You're all about the charts.
Well, yeah, but the thing is, when people get crazy and fundamentals and get thrown out the window, and people are trading based on emotion and fear and greed for shorts, is when you really got to step back from the investing crowd and look from the outside in and look at what's actually happening versus what should be happening. So this is the 5-year tips, Treasury inflation protected securities. It basically predicts, okay, we have some tips on our fixed income portfolio where inflation is expected to be 5 years out. And you can see that we peaked up here maybe first couple months of this year, well above the 3% level, but we've taken a very sharp drop down. And if you want to do a little trend line analysis here from the lows up on the 5-year, we'd say we've actually broken on the red line, and we have this short little green channel that are right about current levels 2.9. I would say if we break below 2.9, the 5-year forward-looking inflation reading is back below 2.9% and likely headed lower. Going out even further, 10-year, same thing. So same kind of deal. We have a red trend line here, testing right about 2.65%. So right there, at the 5-year expectation looking for 2.9, the 10-year looking at 2.65. So the markets are telling us this is not something that's here to stay. In fact, they're pricing in more inflation in the short term than they are in the long term. So long term support 2.6, you get that little green channel about 2.4. You start breaking those lower, and all of a sudden, the crumbling stock market, the less demand from wealth effect starting to come in, and perhaps supply chains easing up, maybe the Fed isn't guaranteed to lock in a 200 or 250 basis points additional increase in the federal funds, as everyone was so certain over the year. Everyone, even Goldman, was saying, "Oh, for sure, we're doing 250 basis points for the rest of the year." And Powell came out and said it right away, and he's like, "We don't even know what we're doing 3 months out." So I like that he took that position last week when he said, we don't even know 3 months, we have no idea. But then when he asked in the press conference, what do you think about a 75 basis point cut? He said, oh, it's not even under consideration. The market initially gave him the benefit of the doubt, and the word that I used in the write-up to clients this morning was he almost took a sanguine approach towards inflation during the press conference, and I think the rest of the market was saying, wow, he seems really comfortable up there the way he's addressing future inflation. Maybe it's not transitory, but maybe he strongly believes it's not going to be with us forever. And then all of a sudden the market thought about it overnight, and they said, hold on, you're just continuing to be clueless behind the curve, and I'm not one to criticize anyone. I really don't pass the blame on anyone, but the Fed's, he said at one time that we don't know what's going to happen in 3 months, but he said 75 basis points is not even in the cards. Kramer was pounding the table on CNBC this morning saying they need to do an intra-meeting 100 basis point rate hike and just get ahead of this. So the fact that he took 75 off the table maybe suggests that the Fed really is continuing to be behind the curve. They need to get this inflation under control, shock the markets, and move up. And the Fed, I think, the market is trying to force the Fed's hand to reopen flexibility to do what it takes to get inflation under control. And I think the minute the Fed regains credibility, because right now they don't have it, I think is when the market stabilizes.
I agree.
Sorry,
no,
Ram.
I'm with you, and I think obviously the Fed is behind the 8 ball a little bit here, and they got a lot of work. I mean, I don't think it's going to be tough for this soft landing to happen. I think when you kind of take into account everything that it's already happened, where we're at today. They've had all the data, so I mean, maybe it was so hard to predict this. I know other people have called that this was kind of, you could foresee this. This was easy to see. I don't know what the Fed was looking at that was different, but I do think when you start looking at some of these tips numbers coming down, and that's a decent indicator of what the market's expecting and seeing, and I do think that's a positive development right now.
Yep.
So yeah.
Okay, so looking ahead, tomorrow we have UMISH, consumer expectations. And then coming up is import-export prices, which I think will also be important, seeing how much inflation is impacted, importing inflation with the strength of the dollar. Next week, interested in retail sales, industrial productions, but then we get housing data next week, which I think will be super interesting because housing was such a big component of that CPI. I think these numbers are going to be very important. We have building permits, housing starts, and existing home sales. I think existing is Thursday. New housing is going to be Wednesday. So that's going to be important. And I considered some of the home builders for the portfolio. The whole world wants these home builders to start building. We just, the demand is there. It's just, we just don't have enough supply. And, I paid attention a little bit in economics class in college. I'm sure you were a better student than I was, right? But I'm pretty sure if the demand is rising, it is elevated, right? The supply will also rise up to meet where that supply-demand curve intersects. Like, we're still in a capitalistic economy. Like, if demand is high, you got to think supply is going to rise up. You know, you look at the valuations of some of these home builders and the yields they're paying. We just got to see signs that, you know, people want to come back to work. Workers are going to show up. They're building a beautiful house right through the woods behind me. I mean, gorgeous. I can't wait to see it here on Ingersoll. I don't know if you know, right? They haven't touched it in 2.5 months. It's sitting there. It's just it stopped the job. I'm just like, it's crazy.
Yeah, that home building's tough. I mean, they've pulled back since the great financial crisis. They've never gone back to take on the same, you know, sort of risks. And, you know, frankly, I don't know what higher rates plus, you know, this fear of a recession right now. I mean, this could have an impact moving forward. Plus, you lump in the supply chain issues. All of a sudden, you know, pricing of new construction is that much higher. You know, there's a lot of headwinds against it. You know, I think the demand is certainly there, but again, it depends where you know, like here in Boston, yeah, there's a ton of demand. There's nowhere to build, but you know, you're not
right. That's a different problem, right?
Different market, but you know, overall, when you look at it, there's so many headwinds between rates and you know, I think there's just a different risk characteristic that they've never jumped back in from 12, 13 years ago, and you know, we're still seeing the impact of it. We're seeing the impact of it right now with where prices are. So.
Yeah, yeah. So let's talk about that wealth effect a little bit. Oh shoot! Sorry, I just unplugged. Hang on.
Yeah, I think this is.
Yeah, so this
is impacting markets definitely, and I think what's interesting about this chart, and this was a follow him on Twitter, Cullen Roach. He talks a lot about you know money and in the dollar and some impact there. He's got some good stuff, but I think it was compared to 2008, 2009. That number was down about 18-19%. This does not take into account home prices. So this wealth effect is going to have an impact, especially today and right now. I mean, this is pretty dramatic. And I think why it's even trending close to what we saw in 08 and 09 is that, you know, we've talked about fixed income is down. I mean, this is the worst start to the year for fixed income, down double digits. Usually as stocks go down, typically you see your bonds going up, and this has just been a different environment. And I think this has led to some of that negative sentiment lately, and definitely has you know, we're seeing some of these bigger sell-offs. There's nowhere to hide right now, and that's the difficult part about this current market. It's like, you know, the Fed's mandate is to raise rates to, you know, cool off the economy, bring inflation back down to a normalized level, and you know, all things considered, it just is working against to a certain extent investors, and we're seeing this big effect right now.
So that's one thing that I'll push back with you on, and I think the tradition. I didn't tell you I was going to do this. I'm going to throw a curveball at you. Sorry. The traditional accepted relationship between stocks and bonds is they are one of an inverse relationship, and I never understood it. And I think there's periods, but I'm going to show you here an S&P chart and the 30-year bond. Okay, so this goes back to when you and I are probably just out of diapers. I was probably out of diapers before you, right about here. You were born right about here, right? 82.
A little bit down. A
little
bit up more.
you puppy.
84.
Oh my God, 84.
So what are you?
You're a millennial. Okay, so
what are you?
So here's what I push back on. So a 30-year bond in black and the S&P in blue. And below here is a 21 period, doesn't matter, 20 period correlation. Okay? So above the line is a positive correlation, below the line is a negative correlation. So you have from the 80s all the way up to 2000, you saw a positive correlation between the S&P and the 30-year bond. So what that means is you have an inverse relationship between the S&P 500 and long-term interest rates. And then the period where they go negative, where bonds do actually serve as a hedge, are the 2002 tech crash and then the 2008-9 housing crash. We then return from 2013 to 18 with a plus 50 to 60%, 0.5, 0.6 correlation. Remember, one is perfect. right? One is perfectly correlated. -1 is perfectly inversely correlated. So on the whole, I would say, except for stock market crashes, and I'm actually making your point also, the past two significant crashes, 2000, 2008, we saw bonds be a hedge here and here in terms of stock market itself. It's different this time because of inflation, because of other reasons. We're not seeing the negative correlation between stocks and bonds. I'm making your point. So the idea that fixed income is a hedge, if this is, I don't think we're on the cusp of a 2000 crash or a 2008 and 9. I don't even think it's close to that. But now we're seeing bonds sell off a lot faster, I think, relatively speaking, where they've been compared to the S&P. So it's more of a fixed income. It's more of an interest rate problem than I think it is a stock problem. So I guess there's 2 points. They haven't been a hedge, except for extreme high vol stock market crashes. And the third time this century is different.
Well, that's why the 60-40 portfolio has been so good for so long, is that, you know, in a long-term down interest rate environment, bonds have done very well. You know, that part of your portfolio, it's certainly shifted today. You know, I think as rates continue to go up, it's not going to be there's going to be an entry point where it makes sense, and we're already seeing, you know, the 10-year came down over the last couple of days. I don't know, I didn't see where it finished today.
Yeah.
I wasn't following it that closely, but I know over the last couple of days it has come down a little bit, which may be a decent sign. At least, you know, people feeling a little bit more comfortable. But at a certain point, especially for the savers, you know, higher rates isn't a bad thing. So again, in the short term, this volatility is not great for fixed income investors, but at a certain time point frame, you're going to see a little bit more you know, comfort easing back into fixed income market, especially when that rate is, you know, attractive enough, and we may get there some point soon, sooner than we may have thought. But
all right, let me see if you're paying attention. Could you think of any reason why TLT, this is the 20-plus year, this is the bond ETF that tracks the 30-year Treasury bond, but it's of durations of 20 years or more. Can you think of any reason why we might have kind of bounced off the 115, 116 here in TLT in this bond annihilation?
That's from about a week ago?
This is May 9th was the low. Today's the 12th. So we're up 3 days. I won't keep you in suspense, but look at the TLT chart. It's the same pattern. It's crazy. Down, up, down. Percent drop was, I don't know, 20-something percent. It's almost the exact same chart as the stock market. It's crazy how it all comes together. So that was a 25% decline up to the B, and then so far to the low, it was a 26% decline. And we're starting to hold. So I almost wonder if that same sort of pattern is starting to hold. Has the fixed income massacre gone far enough and rates are high enough? We see capitulation, and the market is far, you know, going way too far in terms of being so certain of the Fed's actions at the end of 2022. You know, have we seen peak rates, I wonder? And do we go back to a positive long-term bond stock, inverse correlation of bond yield stock sort of relationship?
All right, man. Hey.
I don't know.
We're at 50 minutes. I've been trying to chat.
Really?
I gotta get out of here.
Oh man, we're just getting started, man.
I know. I think we got to tighten it up a little bit. All right, man. No, but this is good. A lot going on. Hopefully, we'll see the trend of the last hour of the market heading into tomorrow. But I think definitely some opportunities are going to be presenting themselves, especially as you're kind of seeing the progression of the sell-off this week, and that's what we're going to keep our eyes on right now. Yep,
sounds good. We'll do a video this weekend. We wanted to talk about Disney, Netflix, big relationship there, crypto, lots happening there, sort of symbolic of the maybe a potential liquidity issue with that stable coin.
Yeah, that feels like the crypto market seems a lot more like 08, 09 than current stock market. But man, that crypto market's scary right now.
I tell you,
it's going away there a little bit.
I liquidated everything out of Coinbase. I did it 3 days ago. I sold everything. I am short in GBTC, the ETF. I'm short the stock. I'm not hanging around for this. It'll probably be fine, but I don't like what Coinbase said. I just wanted to get that out there. Big correlation right now with crypto and tech stocks. Will probably be okay. A few things that we didn't get to, but hopefully it was enjoyable. Thanks, guys. Hit the thumbs up button if you don't mind, and leave a question, comment, and we'll address it. And we'll see you guys next week. See you, Ryan.
All right. See ya.